Good morning, everyone. Thanks for joining us today. We have a great program for you, one that I think you're going to enjoy. My name is Gabe Lengua. As Phil said, I lead the firm's consumer goods group, and I also do a lot of work with mergers and acquisitions. Why don't we get started? This is just a brief overview of the firm. I think most here know of O'Connor Davies. For those that may not, it's one of the largest regional accounting and consulting firms. Depending on which survey you're looking at, top 25 nationally, top 12 in the metro area. And our PKF network, I think, is 10th internationally. That group extends our reach both domestically and internationally. And as someone who works a lot with international companies, that overseas reach comes in handy. These are some in-focus areas at the firm. I say in focus. They've been high-growth areas for us the past year or two. I'll just spend a minute on one, ESOPs. If you're a business owner and you're considering a sale, or if you're a professional, you have a client that's thinking about a liquidity event, you owe it to yourself to learn about ESOPs. It doesn't fit every scenario, but when it works, the tax benefits are very significant. Good times. This is true. Just about every statistic you hear is at a 10-year high, a 20-year high, in some cases a 50-year high. GDP growth has been good. Wage growth has been good. I think the unemployment rate is at a 50-year low. So all of this is good news, certainly for consumer good companies, and provides a good backdrop for those companies. When things are good, when people hear these numbers and things are going well, consumer confidence goes up and consumers spend. And again, good news for consumer companies. This chart, this is the type of chart that any consumer good company would like to see. US spending, consumer spending has been on the rise, on a steady rise the past few years. There's a lot of information on this chart. I would just focus on the blue line. That line is the gauge of consumer confidence. And as you can see, it has gone up. It certainly has spiked recently. It's at about a 20-year high. After the 2008 recession, there was some stops and starts, but recently consumer confidence has spiked. Again, good news for consumer companies. It isn't all flowers and candy. Certainly there are some potential headwinds. These are a few of them. Higher inflation. We are seeing some inflationary pressure. Most companies, consumer companies, have come out and said we're raising our prices. From Procter & Gamble to Unilever, most of the big companies have said they're increasing their prices. I had a client discussion recently where, he said to me, Gabe, I'm reluctant to raise prices. I don't want to turn off my customer. And I said to him, Jim, I get that, but in this environment, if you can't raise prices, when can you? So something he's thinking about. Rising interest rates, certainly a concern. It's a tough balancing act for the Fed. But if they do raise rates a little too aggressively, a little too quickly, could throw a wrench in things. Slowing growth overseas. Our multinationals are certainly concerned about this. It's a concern. I take a little bit of a contrarian view to this. While it is concerning that growth in places like China have slowed down to the extent you can believe the information coming out of China, I would rather see our growth strong and that growth slowing rather than what it was not too long ago when they were growing at 16, 17%, we were growing at 2%. Possible trade war, we've all heard about this, tariffs and things like that. This is a concern. Our clients are concerned with this. I would say this, though, there's a little bit of an offset with the strength of the dollar. So while there are concerns, there is a little bit of that offset. I want to touch on these things here. Changing face of the consumer, new patterns of personal consumption, technology advancements, and how can you have a consumer good forum without at least a little discussion on Amazon? The Amazon effect, I'll just briefly, because I'm going to come back to this. The Amazon effect is real. Certainly it has changed the face of e-commerce, changed the face of the consumer industry in general. I am going to circle back to that a little later. Changing face of the consumer. These are things that any company that's strategizing, that's planning for the coming years needs to consider. Middle class explosion. I feel like this has been almost underreported. We're about to hit an incredible milestone. I think it was the Brookings Institute came out and said that within a year, half of the world population will be considered middle class. Now, middle class here and middle class in other countries, very different, but still a major milestone. Aging population, we are aging. We're not as bad as some other advanced economies. I think we have 15, 16% 65 and older here. Some countries are over 20%, but certainly in the next 5 to 10 years, those percentages are going to go up. Urbanization, the younger generations, millennials, have been flocking to urban centers more than the suburbs, so that's been a changing dynamic. Millennials are a key segment, but what we're finding is companies now, not that they're moving past millennials, I feel like we've been discussing millennials for the past decade, but now they're starting to gather information about the next generation, Gen Z. And what's interesting about that is that they're finding there are distinct differences. Gen Z is not millennials part 2. There are distinct differences. And again, if you're a consumer company, it's important to know that. Touched on a couple of these things. Made in the USA is something George Whitehead is going to speak about in a few minutes. If you look at this, convenience, health and wellness, personalization, not really new concepts, right? Been around for a long time. What's different, what's unique today is how companies, through the use of technology, are addressing these things. I don't think anyone will be surprised by this chart. E-commerce has been on the rise. In the early 2000s, it got off to a little bit of a slow start, but it's really picked up in recent years. The reason why you see it kind of go up and down each year is it kind of slumps as you go into the summer and then increases as you go into the holiday season. We do not get together with our e-commerce clients and have a conversation that doesn't include an e-commerce strategy. But what's interesting is that those conversations are not just how do I drive sales online, they're how do I use that platform to try to drive more foot traffic? Because the physical store is not going away, and I'm going to circle back to that as well. But it's not just how to drive online sales, how do I drive more foot traffic in my stores to the extent you have a retail presence? Artificial intelligence has become a big part of how companies gather information and how they target market you. How many people here have heard of the CLV score? CLV. Show of hands. Okay, interesting. It stands for customer lifetime value. And most people have never heard of it, and if you've heard of it, you don't know what your score is. But companies have this score on you, and they're using that score. How do they have a score on you? Because, quite frankly, I think we know this, nothing's private anymore. When you go online, when you're searching, when you do things, even if you don't realize it, they're gathering information on us. And so they've created this score, and that score is not just to target you for certain marketing, it's also to determine what level of customer service they think you're entitled to. So this is how companies are using artificial intelligence, using things like big data, creating digital profiles. This is the age we're in. I think we've touched on most of these. I'm going to try to move this along. The direct-to-consumer model is on the rise. And this isn't just a consumer thing. This is across just about every industry. You see it in media and entertainment. The Disney acquisition of Fox was driven in large part by trying to expand their direct-to-consumer. In the consumer goods area, this is where companies are trying to get to. And if they don't have it as part of their business model, they're making acquisitions to try to increase this. Direct-to-consumer, again, is not a new concept. But what's a little different now, I mean, there's a profit motive to it. There's a convenience factor to it. We mentioned convenience before. But there are other reasons. Companies want to create a more personal relationship with the customer. They want to be able to control the branding more directly with the customer. And, as we mentioned earlier, they're trying to gather more information directly from their customers. So this is all helping to drive the direct-to-consumer model. Continued consolidation, this is happening. The M&A market has been, we have a bunch of M&A folks here. It's been a very active market in recent years, consumers no exception. We think that will continue, and part of that consolidation, again, is to try to add deficiencies to companies to try to enhance those things, whether it has to do with technology or things like the direct-to-consumer model. I'm going to spend the next 5 or 6 minutes kind of finish up with Insurgent brands. Insurgent brands have certainly changed the consumer landscape. They've had a lot of success carving out niches for themselves, and there's a bunch of reasons. We've listed some of them here. Retailers do like them. They like these smaller brands, these Insurgent brands, because it helps them to differentiate themselves with their competitors. They're nimble. Part of that's just their size, their sheer size, but part of it is, I'll be honest, I think that they do a better job with things like digital profiles, actually better than their bigger competitors. And that allows them to pivot more quickly to adjust to changing customer tastes. They're appealing to millennials, and for a bunch of reasons. A lot of these brands are different, they're distinct. Millennials like that, something different than the larger, more well-known brands. It also, some of these brands address some of the millennial concerns, whether it has to do with social concerns or whether it has to do with things like health and wellness. But as much as millennials like them, venture capital likes them even more, as you can see here. To me, this chart is eye-popping. The amount of money that has flowed into these smaller brands in recent years. They've really provided the fuel for these brands, and in many cases have turned into successful investments. Here, again, continuing to show how they are really making an impact. This shows the percentage of sales for the smaller brands and then their share of the growth. And as you look at the share of the growth, it's incredible. And it's even larger outside of the US, interestingly. But either way, significant impact. These are some of the top selling categories on Amazon. And again, breaks it down by the size of brands. You can see the Insurgent brands, the red bar. A good amount, in a couple of cases, they're larger than a third of that category is Insurgent brands. So again, just showing the impact that they're having on the market. Looking ahead, we continue to see a lot of these trends continuing. Insurgent brands are going to continue to carve out their market share. Consolidation will continue. The effective use of technology, both for marketing and also to determine levels of customer service, we think are going to continue. I'm going to finish up with bricks and clicks. You know, it was about, I guess it was the late 90s, had a lot of conversations with very smart people who said that in 20 years, Amazon was going to put Walmart out of business. I can remember them like they were yesterday. And fast forward, we are now 20 years later, and Walmart has their issues, but they're still a large, healthy, successful company. I think we can over-exaggerate trends. So while I think e-commerce is increasing, and obviously that's part of what's happening, the physical store is not going away. But if you have a retail component to your business, you have to give people a reason to get away from their computer and come to your store. You have to make it an interesting, unique experience. I can think back to when Starbucks started. Starbucks did a great job of creating that third place. You had home, work, and Starbucks. And as crazy as it sounds, a lot of people thought that that venture was going to fail because they couldn't understand why people would come out of their office and go out of their way to go to a store and pay for something that they had for free in their office. But they did, in droves. Starbucks did a good job of creating that place. People wanted to go there. For whatever reason, they wanted to go. So give people a reason to come to your store. Customer service cannot be good. It has to be exceptional. Technology, cutting-edge technology needs to be incorporated into that shopping experience. It needs to be a unique experience. Think of the Apple Store as an example. But if you do that, and if you do it smartly, you'll increase the foot traffic. Thank you.